The Bank of Canada says half of all variable rate mortgages have hit their trigger rate. So what does this mean? And what stage in the bubble are we in right now? That's what we're going to be digging into in this video right now. So let's get into it. So where I believe we are right now is we are heading into this return to normal phase, as you can see on the chart. Now, the interesting thing is during this phase, you essentially have people who are in denial. They start to see that prices are rising and they just flood the market with inventory. So you essentially see this bull trap that plays out. And that could be coupled with an economic crisis that the yield curve is telling us is going to happen. But everything is looking great. The stock market is going up, bonds are going up, everything is looking fantastic. We're getting a soft landing. Even Powell himself said that the probabilities of a soft landing are increasing. So this is reasons for optimism, right? Well, as we can see from this chart, you do get that optimism come back, and it comes back and it's all part of the cycle. It's all part of the bubble cycle with that return to normal phase in the bubble cycle, which we are in right now. So now let's examine what is different between now and 2008 and some of the warning signs that we didn't have in 2008 in Canada that now are flashing code red. The first thing I want to draw your attention to is private debt to GDP, because when you look at private debt to GDP, it is clearly showing a peak right now. And if you compare that to what happened in the US, it's a very, very interesting chart now, isn't it, all of a sudden? Private debt to GDP is an interesting metric because that measures the amount of debt which is in the corporate sector, which businesses hold on their balance sheet, which has essentially gone parabolic since 2008. So back in 2008, corporations were in a much better position than they are right now, where they're loaded with debt, and that creates a huge problem because we've got interest rates that are very high right now. And could that mean that a lot of people are about to become unemployed? Well, we know that's true with Amazon and Facebook and so many other companies that are laying off people and are announcing this time after time, week after week. We hear of a new company that is laying off staff. So when you think about these companies, these are all really strong companies. These are all the poster child of the dot-com era and the dot-com bubble. These are all the tech growth names that have been positioned for great things. So why are they laying people off? Another thing that is flashing code red is household debt to GDP. If you look at this chart once again, you can see on this chart that we have peaked right now. And we haven't peaked in the past. We didn't peak in 2000s. We didn't peak in 2008. So we can actually say there are some indicators that are flashing code red, because if you look at what happened in the US with household debt, you can see the bubble grew, the bubble peaked, and then it started to go down, and that was the demise of this massive debt bubble. So now we've actually seen a peak in both household debt and private debt. It's a more compelling story than it was in 2008. And this is what's different to 2008 and 2016, when real estate prices had a minor correction, and it was like a trampoline essentially, because they just went up even more, and seemingly people believed that, hey, this thing cannot go wrong. The housing prices are just going to go up forever. And I will never forget in 2021 how many people I saw saying, you know, now is the time to get in. Housing prices are never coming back down. And then, of course, the first rate hike, just 25 basis points, turned the entire Canadian market, even including places that people thought, oh, those will never go down, because they didn't go up that much, even though they've gone up more than 200% since 2003 when you look at this bubble. So it's very, very interesting that all the markets turned, and I think that is a very, very key thing that we have seen. The sentiment is now shifting. We've hit a ceiling in prices and payments, and the only way we're going to get out of this is a huge stimulus package that boosts incomes, coupled with negative interest rate. And if you're wishing for that, I think you're quite frankly an idiot, because the ramifications for things like the currency and the debt market could create a huge depression that lasts for 20, 30 years. It could create serious holes in everybody's wealth that nobody would want, and everybody would be saying after, gosh, I wish I didn't wish for that, because look what's happened now. But what about the Bank of Canada? They said half of all mortgages have hit their trigger rate. Could they default? Is this what the yield curve is telling us is going to happen? Is this why it's so inverted like it was during the late 1980s? This is further evidence that this is totally different to 2008. The yield curve was not even barely inverted in 2008 compared to how the inversion looks like today. And you can see on this chart that it's the worst inversion since the late 80s, when there was a banking crisis in Canada, when there was many things that went wrong. We know that the outstanding mortgage debt has grown by 333% since 2003, when the super bubble really started to go up. We also know that Toronto home prices have gone up 325% within the same period. So we know it's not wealth, we know it's debt. Eventually the payments become so large people default, and it's not if this happens, it's just a question of when will this happen. It's a question of how long until it happens, not if it's ever going to happen. And people need to realize and understand that. Because when you look at this chart, realize this is outstanding mortgage debt. So all the money that people are paying off into their mortgage has meant that this thing still hasn't gone down because of the amount of growth. Again, I come back to the point that this isn't wealth, it's just debt. It's a debt super bubble. Even in places like Calgary, where people say time and time again that home prices haven't gone up that much. Single family homes have gone from $200,000 in 2003 to $626,000 in 2023. That's a 213% rise in home prices, even in Calgary, where people say that home prices haven't gone up. And we know that incomes have not gone up that much at all. Wages have gone up around 60% during the same period. So once again, you know that people are supplementing their income with debt all over Canada, and that is what has grown this thing into the monster that it is today. All of this is a recipe for disaster, and no politician is going to be able to fix this. I don't care what they say or what they think, they're not going to be able to fix this. Canada, quite frankly, looks like the next Japan. And all of this growth has happened whilst the population has only grown by 20%. I know they told you immigration is the cause of it. They told you all these different things are the cause of it. They told you the Okanagan was such a great place because it's so mild even though it's cold in the winter. I mean, all these excuses, I've heard them time and time again. And it doesn't matter where you travel to. When I went to Phoenix in December 2021 and was chatting with people, it was interesting to speak to them and hear their perspective, because they were saying, well, there's all these people retiring, there's all these tech workers coming, so that means it's never going to go down. And look, right now it's going down. There's no fundamental support for this bubble. The only thing supporting this bubble is the greater fool theory, and once that ends, it's game over and it's done. So if you've enjoyed this video, you might like that one there. You might also like that one there. This video took me a while to make. I hope you enjoyed it. Thank you so much for watching. And I hope to see you in the next one. Take care of yourself.